My dear friends, welcome back. Today, I want to talk about a paradox, one of the most uncomfortable truths in all of investing, a truth that has frustrated generations of investors, misled entire financial communities, and quietly destroyed more wealth than any market crash ever could. The truth is this: most investors lose money even in bull markets, even when prices rise, even when news is good, even when opportunities are everywhere. Now you may ask, how can someone lose money when everything around them is going up? The answer, my dear friends, is simple. People do not lose money because of markets. They lose money because of themselves. Let me take you back to the 1940s and 1950s. I watched investors make the same mistake over and over again, waiting for the perfect moment, chasing the hottest idea, selling too early, buying too late, falling in love with stories, and abandoning discipline when excitement filled the air. It didn't matter whether the market was rising, falling, or standing still. The pattern was always the same. They reacted emotionally instead of thinking rationally. And in your era, in the years after 2025, this problem is magnified. Your world is faster, louder, and more seductive than mine ever was. Prices move in milliseconds. Predictions spread like wildfire. Narratives dominate headlines, and excitement, that dangerous emotion, becomes a constant companion. But even with all this technology, the fundamental reason people lose money has not changed for nearly a century. They do not understand their own behavior, not market behavior, not economic behavior, their own behavior. Let me give you a simple example, one I've seen repeated thousands of times. An investor buys a stock during a rising market. At first, he feels confident. The price rises. Then he feels brilliant. The price rises again. Soon, he feels unstoppable. But eventually, something happens. The price rises a bit slower, or perhaps it even stops rising. And in that quiet moment, something inside him changes. Confidence becomes impatience. Impatience becomes doubt. Doubt becomes fear of missing out on something better. And fear becomes action, the wrong kind of action. He sells too early, convinced the opportunity is fading. And then what happens next? The stock continues to climb without him. This is the tragedy of bull markets. They expose impatience, not intelligence. Most investors do not hold long enough for compounding to work. Most investors do not ignore noise long enough to see value clearly. Most investors let emotions dictate decisions that should belong to reason. And so they lose, not because the market punished them, but because their own minds betrayed them. In this lesson, I want to show you the 3 great behavioral traps that cause investors to lose money even when markets are rising. The trap of impulse, the trap of narrative, the trap of identity. If you understand these 3 forces, and if you learn to recognize them in yourself, you will avoid the fate of the majority. You will stop repeating their mistakes, stop reacting to their emotions, and begin thinking with the calm, patient discipline that defines intelligent investing. Let us begin. Now, my dear friends, let us examine the first great behavioral trap, the trap that destroys more wealth than market crashes, recessions, or bad companies, the trap that seduces even intelligent people. 1. The trap of impulse. Impulse is the silent enemy. It whispers, act now, don't think, don't wait. Opportunities disappear. In bull markets, impulse becomes a wildfire. People believe rising prices confirm their intelligence, and this false confidence accelerates their decisions. They stop analyzing. They stop comparing value to price. They stop asking the only question that matters. Is this business worth what I am paying? Most investors do not lose money because they miscalculate. They lose because they do not calculate at all. Bull markets reward movement, but wealth rewards patience. Impulse confuses the two. And so the average investor buys not because the business is valuable, but because the crowd is excited. The danger is that the crowd changes direction faster than the investor can react. The moment excitement slows, the investor feels trapped, uncertain whether to hold, sell, or buy more. But intelligent investing requires none of this confusion. It requires discipline, not speed. Reflection, not reaction. When you feel the urge to act quickly, stop. The market is not going anywhere, but your capital might, if you surrender it to impulse. Now let us move to the second great behavioral trap, the one that blinds even seasoned investors. 2. The trap of narrative. People love stories. Stories create meaning, comfort, and excitement. But in markets, stories can be disastrous. A bull market is a breeding ground for narratives. This time is different. This company will dominate everything. Valuation no longer matters. Everyone is buying, so it must be safe. The danger of narratives is that they replace analysis. Investors stop examining earnings, balance sheets, and competitive realities. They begin predicting the future instead of studying the present. But, my dear friends, stories do not produce cash flows. Businesses do. A popular story can push a stock price far above its intrinsic value, but it cannot support that price forever. And when reality returns, as it always does, the investors who bought the story are left holding the consequences. This is why intelligent investors avoid the seduction of narrative. They do not buy hope. They do not buy potential. They buy earnings, assets, and durability. If the story disappears tomorrow, the investment should still make sense. If it does not, you are not investing. You are speculating. Bull markets make every story sound believable. A rising tide can make even a fragile ship look strong. But when the tide turns, the weaknesses become painfully clear. And this brings us to the most dangerous trap of all, a trap invisible to most investors because it lives within their identity. 3. The trap of identity. When markets rise, many investors forget what they are. They stop being students of value. They stop being rational thinkers. Instead, they adopt a new identity. I am a genius. Bull markets flatter the ego. Short-term gains feel like skill. Rising prices feel like validation. Soon, the investor begins believing he has a special ability to sense opportunity. At that moment, he becomes vulnerable. Identity-driven investing is the most expensive form of investing. Because when a decision threatens the ego fights back. The investor ignores warning signs. He refuses to sell losing positions. He doubles down to prove himself right. He confuses luck with talent. He treats the market as a test of personal worth. And in doing so, he becomes blind to risk. Most investors are not defeated by the market. They are defeated by the need to protect their identity. The intelligent investor, however, remains humble, especially in bull markets. He knows that rising prices reveal nothing about his skill. He knows that discipline, not ego, determines long-term success. He knows that markets do not care how he feels or what he believes. He does not need to appear brilliant. He needs only to be rational. In the next part of our lesson, I will show you how these behavioral traps lead investors into predictable patterns that repeat every decade, regardless of technology, knowledge, or economic progress. And more importantly, I will show you how to avoid these traps, even when the world around you is celebrating and losing judgment. Let us continue. Why most investors lose money, even in bull markets. Now, my dear friends, let us examine how these behavioral traps create predictable patterns so consistent that I could observe them in the 1930s, the 1950s, and even in your era, nearly a century later. The tools change, the companies change, the headlines change, but human behavior does not. Let me show you exactly how investors lose money in rising markets, step by step. Pattern 1. The rise of confidence. It begins with a small gain. A trade goes well. A stock rises shortly after purchase. The investor feels satisfied, then proud, then confident. Confidence in moderation is harmless, but in bull markets, confidence rarely stays moderate. It grows quickly, pushing the investor into dangerous territory. Soon, he begins to believe rising prices confirm his judgment. He starts thinking, I knew this would happen. I can see the trend. I understand this market better than most. But confidence built on rising prices is the most fragile confidence of all, because the moment prices slow, everything collapses. This is how bull markets create overconfidence, and how overconfidence opens the door to the next pattern. Pattern 2. Buying higher, selling lower. The investor who feels brilliant begins buying more, but not because the value has increased. He buys because the price has increased. In a bull market, this behavior becomes extremely common. People buy more aggressively as prices rise, believing rising prices are proof of safety. But when a small dip appears, even a normal, harmless dip, their confidence evaporates. The very force that pushed them to buy now pushes them to sell. And so the pattern emerges. Buy high, out of excitement. Sell low, out of fear. This pattern has destroyed more wealth than any recession. Intelligent investors do the opposite. They buy when value exceeds price, and they sell when price exceeds value. Emotionally driven investors reverse the order, and then wonder why they struggle. Pattern 3. Chasing what already happened. Most investors do not buy the future. They buy the recent past. If a stock has risen for months, they assume it will continue rising. If a company has produced exciting headlines, they assume the excitement will continue. If analysts praise a sector, they assume the praise is meaningful. But investing based on what has happened is a costly mistake. The market is forward-looking. By the time the average investor becomes aware of a trend, the opportunity has usually passed. Bull markets make this mistake extremely common. People chase momentum, forgetting that momentum does not last forever. They are not investing. They are following footsteps that lead nowhere. Pattern 4. Ignoring valuation entirely. In every bull market, there comes a point when valuation disappears from the conversation. Price becomes the only topic. How far can it go? When will it hit the next milestone? How much did you make? But valuation is the language of reality. Ignoring valuation in a bull market is like ignoring gravity while climbing a mountain. It feels fine for a while, until the moment you slip. Intelligent investors anchor themselves to intrinsic value. This anchor keeps them stable when excitement pushes others into risk. The investor who ignores value may profit temporarily, but his losses, when they come, are permanent. Pattern 5. The sudden collapse of confidence. Every bull market eventually slows, not collapses, merely slows. And when that happens, something extraordinary occurs. Investors who felt like geniuses only weeks earlier suddenly feel confused, uncertain, and exposed. Their confidence was built on rising prices, and when prices stop rising, the foundation disappears. They begin asking, should I sell? Should I hold? Should I buy more? What if I'm wrong? Uncertainty takes over. Fear replaces excitement. And this, my dear friends, is precisely when most investors lose money. Not during the crash, but in the slow, invisible moment before the crash, when emotions shift and discipline disappears. In the final part of our lesson, I will show you the antidote, the mindset and framework that allow you to earn profits steadily during bull markets and protect them when the cycle inevitably turns. I will show you how intelligent investors behave differently, why they avoid these traps, and how you can build a psychological advantage that lasts a lifetime. Let us continue. Why most investors lose money, even in bull markets. Now, my dear friends, let us discuss the antidote, the mindset that allows intelligent investors not only to survive bull markets, but to benefit from them without falling into the traps that defeat the majority. Because the truth is this: bull markets do not reward intelligence, they reward discipline. Let me show you the 3 principles that separate those who thrive from those who merely participate. Principle 1. Anchor yourself to value, not price. The average investor watches the price and reacts. The intelligent investor studies value and decides. When price rises above value, he becomes cautious, not excited. When price falls below value, he becomes interested, not afraid. He does not chase what is popular. He does not flee from what is momentarily disliked. He treats price as an offer, not a command. This single discipline protects him from the emotional chaos of rising markets. While others are intoxicated by price momentum, he asks only one question: is this business worth what I am paying? If the answer is no, he steps aside, no matter how thrilling the story. If the answer is yes, he buys, even when no one else is paying attention. This is how wealth quietly accumulates. Principle 2. Let compounding work without interference. Most investors never experience the true power of compounding because they interrupt it constantly. They buy and sell, they switch strategies, they chase the newest opportunities, they allow fear and excitement to dictate their timing. But compounding requires stillness. The intelligent investor holds high-quality businesses with durable earnings and reasonable valuations for long periods, allowing time, the silent ally, to do what short-term traders cannot. A bull market may tempt him to sell too soon, but he resists that temptation because he understands something essential. A long-term investment is not validated by a short-term gain. He lets the business grow. He lets the earnings accumulate. He lets his position mature. Other investors celebrate quick profits. He celebrates enduring profits. Principle 3. Master yourself before you master the market. In bull markets, investors believe they are competing against the crowd. They are not. They are competing against their own impulses. The intelligent investor understands that success does not come from predicting prices. It comes from mastering temperament. And so he cultivates 3 rare abilities. 1. The ability to wait patience is a superpower in a world that moves too fast. 2. The ability to ignore noise. Most information does not matter. Most opinions are irrelevant. Most predictions are entertainment. 3. The ability to remain humble. Rising prices do not mean rising skill. He remembers that markets reward discipline, not ego. When you master yourself, the market can no longer manipulate you. You move rationally, not emotionally. You act deliberately, not impulsively. Your mind becomes the strongest asset you own. Final message. My dear friends, investors do not lose money in bull markets because opportunities are scarce. They lose money because their behavior is undisciplined. They buy too late, sell too early, chase excitement, ignore value, protect their ego instead of their capital. But you are learning to see differently. You now understand the traps. You recognize the patterns. And you know the principles that allow you to rise above the crowd. If you anchor yourself to intrinsic value, if you let compounding work quietly, if you master your temperament before trying to master the market, you will not be part of the majority who lose wealth in rising markets. You will be among the minority who build wealth slowly, steadily, and intelligently. Bull markets tempt the crowd to believe they are brilliant, but the intelligent investor knows the truth. You do not become rich because the market rises. You become rich because your discipline rises with it. Thank you for spending this time with me. In our next lesson, we will continue building the mindset and methods that protect wealth through every cycle. Until then, stay patient, stay rational, and always insist on your margin of safety. Let us continue.